Good morning, everybody. Welcome back to the Schwab YouTube coaching channel for our Thursday edition of Trader Talk in today's market. I'm your host, Kevin Horner. It is a rainy day here in Denver, Colorado. Ready to get down to business with all of you, though. So say hi to my friend John McNichol there in the chat. He's going to keep an eye on things for us today. Of course, answering questions that I'm unable to get to for y'all live in the moment here, but you are welcome, as always, to post in the chat for the duration of our show, and I'll certainly work to keep an eye on things for you there. You know, we did have some interesting developments over the last 24 hours since we spoke last here in Trader Talk. We've had some shifts into what could be policy side of things here. We did have the U.S. Court of International Trade ruling that perhaps the administration cannot impose tariffs that it has been attempting to impose. And of course, that imposition of these tariffs has led to a lot of trade discussion and work towards deals. It leaves us with, yet again, more uncertainty in this market. So let's see today just how we're looking to digest that. We'll talk about some levels of import for all of us as traders. So with that in mind, if you're not already doing so, everybody, make sure you're following us on X. I'm available there, Kevin Horner CS. And don't forget to make sure you're subscribed to the Schwab YouTube coaching channel. At today's conclusion, I'm going to make sure to highlight minor update for you there so that you know where you can access an upcoming schedule for all that we do for you here on the channel. With that, let's move in and to our disclosures, and then we'll dive into the conversation as always. So please remember that our discussion here is exclusively for your information and your education. Simply put, we do not make recommendations here. We do not endorse a particular strategy or approach to trading the market. We do talk, however, technical analysis in this segment quite heavily, and in so doing, we'll remind you that technical analysis is simply a complementary viewpoint to what you're likely already doing, your fundamental level of research, of course. And beyond that, we'll remind you that decision-making probably needs a wide swath of inputs. So simply there, consider as many variables as you can when making decisions. Try not to lean into one specific thing or approach. Try to take the whole picture as best you can. Now, if you're new to our show here, we generally work through a top-down method of the market, and that means we'll start with our broader indices. We'll look at the S&P 500, the NASDAQ 100, and the Russell 2000. Definitely going to look at the semiconductors today on the news here, and of course, following NVIDIA's smash report late after the bell yesterday. So we'll see how that's working. We'll see how semis are working. We're going to look through the sectors as well and just try to level set a little bit on some particular chart viewpoints on those 11 U.S. sectors. Of course, that also helps us to understand how investors and traders are feeling about deploying money. Today certainly has the makeup initially of a risk-on day. We're going to be very intently watching the first few hours, though, and it's going to help us out quite a bit in understanding whether we've got something to work with here a little broader than maybe just a one-day or even a morning open rally, as we have seen. So let's talk about what's going on with the S&P 500 here, everybody. You'll see we're up about 40 points, 0.7% visually on our chart. We'll continue to highlight the bounce back that we have had here right off the rising 20-day moving average. So if we're talking about things from simply a price action approach, we bullish traders enjoy the fact that we've had a wonderful push from these lows. You can draw your trend line like so. If you don't like manual trend lines, you might very well fall into the comfort zone of utilizing these dynamic moving averages. We're looking at the orange one here. That's the 20-day simple moving average. And you'll notice we've been above it since back here on April 23rd. And that's a wonderful development because now for many traders in that 4 to 6 week window of time, it affords them the opportunity to utilize the 20-day moving average as their zone of support. What does that mean? Well, for a lot of traders, it means you can come to this level, you can intraday trade to the lows, or rather to the orange line or through the orange line to the downside. And if you can recover in so doing, recover and close above that 20-day moving average, then ultimately you're looking at that as a successful test of what could be considered support. And really, that's what happened here with Friday's week open. You'll note here we had that gap move lower from Thursday into Friday. The low was held right at the 20-day moving average as that again continues to upslope. And then the very next session, Tuesday morning, granted on news out of the administration, but we got a gap. We traded above the high of our low day. And so we have a little bit of a continuation. Now, what are bulls looking for today? Yes, the headline was great in the sense that if in fact the U.S. court, the International Trade Court, can apply these types of restrictions on the administration, which remains to be seen, I would suggest, we could have a breakout. That's a potential scenario. But what are we needing to see to at least encourage the bulls there? So let's look at that 5-minute bar. And a lot of you are going to say, hey, Kev, that's pretty obvious. We just need to make new highs up here over 59.65. And you wouldn't be terribly incorrect. I think a lot of traders are going to look for new highs. That'll certainly give you something to consider. But if you want to be a little bit more fine in your approach, we're going to work with the 5-minute bar here. And let's just, in fact, actually, I'm going to change off of 5 minutes. What else do I have? There's my 4-hour. No, we're going to go back and change from 5 minutes. Let's do this as a 30-day, 1-hour bar. And really, you can see the level here, everybody. I think, actually, I'm wrong. I'm going to go back to my 5 minutes. My apologies. So look at where we were yesterday. I'm going to draw this line in here. Now, the white line that I drew above, this white line right here, this white line is the peak of the last 2 weeks, right? That 59.65. That's kind of important. But from an intraday or a very short-term basis, notice that we basically opened at 59.40 and have initially pulled back right off of that. Now, it is favorable, as many bulls will tell you, that we opened and gapped R1. That's that first red line here on my pivot points. Remember, the pivots are simply calculations utilizing yesterday's open, high, low, and close, and establishing the equilibrium price around which the SPX should trade today. That's what that purple line was designed to tell us heading into the session. However, with this optimistic open and opening above R1, many traders are going to refer to R1 today as the pivot. And that's going to be instructive for us, right? Because now if we trade under 59.25, that's basically our low of the day. If we trade under that, we have an opportunity to see a pretty decent quick move to the true pivot there at 59.03 or so. We want to see a bounce here off of this ledge at 59.25. We don't want to see the give up of our opening gap. So I wouldn't call this bad in any way. This is a great start, but we traders, we have to establish the levels where we're going to take action. I say it all the time. Those of you that are here frequently, you heard me say this. It is imperative that we know where we want to take action. So if you were long into the day and you're looking at today as that risk on scenario and there's more opportunity for that, you're looking to see, can we trade through with any conviction through 59.40 to the upside? That's going to be a very short-term important level for us. So hopefully that gives us some context for the day here at the moment, everybody. Okay, let's migrate over back to my daily chart. We're going to look at the NDX of 0.9% here. NDX did break through this upper level. As you can see, we've been kind of pushing this ledge at around 21,450 or so. We got through it on today's open, probably an R1, almost an R2 gap here, but it was quickly faded. Again, not terribly shocking. I think some traders were ill-positioned heading into the afternoon on the earnings wait from NVIDIA. Some traders were waiting on that as opposed to positioning in advance of it, and that's perfectly appropriate. And then we got, of course, the news from the Court of International Trade, and that's kind of what led us even further. So a good open out of NVIDIA, positivity as it relates to the potential for tariffs not being implemented, and you're getting a little bit of profit taking off the open initially here. So not a huge move, about 100 points off the top, but many traders are going to still eyeball probably R1 as a short-term area of support in here. Would like to get a bounce at that R1 right around 21,450. But if it were to bounce off of yesterday's high instead, well, that would be a little instructive as well, wouldn't it, everybody? I mean, if you're a short-term trader, what are you looking for? You're looking for the places where the selling can lose steam, and that may be yesterday's peak. And if that's the case, what do we often say about breakouts and retests? Commonly, stocks and groups of stocks, indices in this case, as they move through areas of resistance, if they come back to that area of former resistance, now potential support, then it can be tested and move off of that. And that can be a new validation level for traders, right? So this can be, if we move off of this level, if the NDX pushes higher, back up above R1, makes a new high, and continues running for the day, well, a lot of traders are going to look at this bounce spot as the place to put an exit strategy, maybe a stop order or a place where trades below that level encourage them to start taking some dollars off the positions, out of the positions and off the table, building more cash. Again, I am not discouraging the bullishness we've seen. What I am encouraging, however, is to notice that the bullishness is not running away from us this morning, right? We didn't open and just continue pushing aggressively. So that just seems a little bit notable. So you'll just put a pin in that for the way things are acting off the jump today. Okay, so the NASDAQ improvement, let's see if that maintains for the day. Let's move on into our small caps. We've talked about the necessity of this group to make some new highs because we've been beaten back at this 2100 process, or this 2100 level, 21 up to 2110 or so at my white line. We have continued to make higher lows along the way, as we can all see. You know, we've got the trend line, and I can draw it in like so. You've got your 20-day moving average, also above it since the same day, May 23rd. So holding the 20-day, albeit 1 day beneath it, or pretty close to beneath it. I'd bet to be closed pretty much on it on this day. So nonetheless, higher lows, trying to get through that 2110. Can we push and get a little bit of love to the small caps? Right now, it's still setting up as such. You're right in the middle of the recent range. So a lot of traders would tell you that given the most recent development here, there's not a lot of room to maneuver if you're looking to add money right now. Whether you're bullish or bearish, right? Because you won't feel confidently bullish until you move through 2110 on a close. And conversely, you might not feel confidently bearish unless we were to take out this low, which would be around the neighborhood of 2010. So you got about 100-point wiggle room range here where traders may not really be taking a whole lot of action, to be quite honest. So risk versus reward is not ideal whether you're bullish or bearish as it relates to the Russell here, given that we're right smack dab in the middle of it all, it would seem. So that bears obvious watching. And of course, when you're thinking about the Russell, you're probably thinking about rates to a certain extent. Couple of things that I'm going to point to here. Rates are dropping a little bit. We're off about 0.6%. But some of those rate sensitive groups are moving today. I'm going to look at charts here in a moment in the sectors, but real estate is up and utilities are up a little bit with the fall here in yields. So quick peek on yields. Red candle today. I think if you're watching the true trend, probably paying attention to this 4.4 level. And again, the 20-day moving average in orange being maintained. Essentially, what we've established a new level here. If we were talking about this from a technical basis exclusively, and I was looking at this as an individual equity as an example, the thing that stands out the most for many, I think, is this downtrend having been broken and then maintained. So it broke here officially on the 8th of May, and here we are on the 29th. So we're a good solid, 3 weeks of maintaining the breakout here, right? So the fact that we have broken and held a level of support seems notable. Doesn't mean yields have to continue to climb, but as we continue to learn about the external forces that have impact on yields, the number one being the interest in buying up U.S. Treasury debt. If we are buying up that debt, if we are willing to buy up that debt, well, then that will continue to push yields down. that would be okay for us. However, if, for example, the interest in U.S. debt continues to wane and we do not get the purchasing of U.S. debt, but rather the selling of the U.S. treasuries, that is going to continue to push yields higher. And that speaks to the lack of, to a certain extent, the lack of comfort as it relates to investing in the U.S. And the U.S. economically. So I think it bears watching. I don't think there's a lot of development here, but I think the big takeaway as it relates to yields is, simply put, we have broken a downtrend, not only broken, but maintained a new short-term uptrend. So let's see how this plays out, monitoring that 4.4 level, or 44 as it is on the actual TNX EGI. In terms of yield, we just moved that decimal place one spot to the left, and that gives you an estimation of percentage return, or percentage yield rather. Some good questions here in the chat as always. One of my favorite questions inevitably is from Michael here about advising which of the moving averages is most important to watch. And really, it has a lot to do with one's trading process, Michael, as anything else. To be quite simple, what we work with here in Trader Talk are very basic moving averages. I have access to a multitude of them over here in my tools box, as you can see, but I rely frequently on some of the more actively utilized moving averages, those being the 20-day simple moving average in orange, the 50-day in purple, and then the 200-day in blue. Now, the answer to your question is it really depends on how the security you're watching, the index you're watching, how is that acting relative to that moving average, which is to say, which moving average at this moment in time is most respected by the instrument we're working with or looking at. As it looks at the SOX here, for example, again, we can talk about the 20-day moving average in orange, having recaptured. We've been above it since the 22nd of April here. Notice how the pullback here was to the 20, but not below it. We are a ways away from the 50-day. And so ultimately, what this implies to the short-term trader is you've got some areas where you can make decisions before allowing it to fall to the 50-day moving average. And for a lot of people, that could be as simple as doing the math on it, everybody. Look at the difference. We're talking about 325 points almost from the 20-day at 46.90 to the 50-day at 43.65. That's a big move, about a 5% drop. Not everybody is going to want to stick with that, even if the 50-day is the moving average that they prefer. So just as an example, from a trade management process here, some traders who've been long something like the SOX or an equivalent investment opportunity within the group might look at this and say, well, I'll stick with my full position until we get a close below the 20-day, which would be a departure from what's been working, from what has been happening. It does not necessarily mean that a close below the 20-day is going to result in only downside pressure, but it is a change to the trend. And a change to the trend for many traders is a shift, and it encourages them to take a little bit of risk off the table. Okay. Now, if you're that same trader who doesn't pay attention to the 20-day as frequently and simply likes the 50-day, you might say that you're comfortable with the move all the way down to the 50-day, and that could be your important level, right? But do the math. That's my encouragement. Look at the levels and say, all right, if I hold everything I have on my position and I stick with it, even though it's closed below the 20-day, I am at greater risk now that it moves lower, possibly as low as the 50-day, possibly lower than that even, of course. Always consider our worst case situations, everybody. But if it makes that move and the path of least resistance is lower and it ends up down there and I'm holding as many shares as I'm holding today, how am I going to feel about it then, right? What's going to make me feel better? What if I said I'm going to sell half and it gets down to the 50-day? Well, now I feel a lot more comfortable because I didn't have to ride a full position down another 5 percentage points, right? I can just stick with the portion that I'm comfortable with. And if we're wrong about selling here, well, just remember that the barrier to re-entry is negligible. It really is your mindset that's going to keep you from buying back if the trend gives you the comfort to do so. Remember, you're not paying, generally, the majority of your investment opportunities here are not coming with commissions, right? So you have an opportunity to re-enter if you exited wrongly. And remember, part of trading is admitting that we were wrong as quickly as possible and getting on the right side of the trade as quickly as possible. So for a lot of traders, that process of selling a little as things weaken, buying more as things improve, these piecing in and piecing out scenarios is a good way for many traders to manage their emotional tie to their trading and to their process. Hopefully that's kind of helpful for you, Michael. That was a little bit more of a winded answer to your question, which was fairly basic. I apologize, but wanted to make sure we addressed it because moving averages are so important. You know, when we're thinking about which is the most important, I just wish I could answer that so clearly, but it really is different for every trader and every instrument that we may very well be looking at. Okay, so as it relates to the SOX, very similar chart here, right? Moved through the 200-day moving average, good gap open. If we were talking about this from just the short-term standpoint, many traders would point out that we broke what appeared to be a bit of a bull flag over the last 3 sessions here, moving through the 200-day moving average. Now today, day one above it. So do we have a little bit of an opportunity to show some strength over the coming days here? Closing above the 200-day for a few days in a row would be wonderful for many traders, right? That would be sign of some confirmatory action here. Let's look at this on the 5-minute bars. So again, excellent open, come back, and to this point, our bounce is actually happening above the high we created yesterday. So this zone becomes kind of notable and interesting. We'd love to keep us basically above this for the day. And I could probably draw it down to the R1 level. Not a surprise. Look, you're going to get some intraday price action, everybody, that could take you lower. Remember, sometimes volatility will play into that. If we get the bounce here on the SOX and everything maintains from here, that would look fantastic, especially if it just got back in gear very, very quickly. The initial move here is a bit of a fade off the open, as you can see, down about 50 points at this spot here. We gave back about 60 total to the intraday low. So that seems kind of notable. But again, the bias this morning is pretty darn optimistic at this point. Let's see some more conversation around. Yeah, you know what, you guys, you're right about those futures moves. Before we kick it off of the majors and look at some sector action, I thought I could bring over. I've got a chart that let me see if I've got it built. Oh, I'm wrong. I don't have it built. That's figures. So one of the charts that I've been working with is something very simple because what it can do is give you some ideas on overnight price action, and it can kind of validate things for us. So I'm going to bring a new chart over here. I'm going to unlink. I'm going to set this up. Let me actually, I might even have this all ready to go. Let me see. Don't think I do. No. All right. So here's what I'm going to do, everybody. Let me hide my detail here. I'm going to change these to just 5-day, 5-minute. 5-day, 5-minute, good. Eliminate my RSI, we don't need to see that. So just the volume. And putting them side by side, everybody, I am going to make one of these the futures contract for the VIX, and one of these the futures contract for the S&P 500. And it can give you something to keep an eye on if you're trying to get an understanding of intraday price action. You'll notice what has occurred here. And when I say a fade, basically, look at what happened in the aftermarket yesterday. So, you know, we got a huge pop to the upside with the note out of the U.S. Court of International Trade. That's what this move to the upside was. And then we got all the way up to that 6,000 level. And then overnight here, basically, we've faded, right? Now, we basically came right back to where we were. And so it's a decisioning point once more on the futures. Now, remember that the futures and the SPX, they are relative, but the valuations we can't really speak to here. But I think it's notable nonetheless to kind of give you some inkling of where trader sentiment and ideas reside here, everybody. I think that this was pretty darn notable. Now, one thing I noticed is that my chart studies are a bit off, so I'm just going to change this a little bit. I've got some 5-day studies in here, so let me see. 5-day moving averages. Oh, that's not the one I wanted. Got one more in here. There it is, 5-day, 5 minutes. So this is using a 20-minute or 20, pardon me, a 20-period exponential moving average. That's this line here. And basically, we have been below it for really, much of the morning today here, everybody. Taking this out here seems a little notable. So again, just if you're thinking about tracking the markets outside of your standard hours, recognize we can't do that necessarily with our individual indices. You might consider doing it with some of these futures opportunities. Remember, trend analysis is going to be very consistent from one instrument to the next, but the values that you see on the position here are not. So, of course, we're at 59.40 on the futures, and if we skip back to the SPX here, we're at 59.30. They're similar, but not identical. Ultimately, that's what I want you to take away from that. So, give consideration to that, everybody. You can get some additional detail out of the market just by working with some of the futures there. And for a lot of traders, eyeing the S&P futures alongside the VIX futures can give them a little bit of confirmation as well. Okay, let's see what else we've got here. Well, Rita, your question about the possibility of breaking an inverse head and shoulders, probably talking about the Russell here. We talked a little bit about this yesterday with Brent Morris, of course. You've got the head right here. We've got a left shoulder in this vicinity and then a right shoulder over here. Unfortunately, we can't really talk about the likelihood. I mean, it all comes down to if then. And that's really the most important thought process for traders, everybody. It's not that technical analysis is telling me what is going to happen next. It's that if this occurs, well, now I know that I've got new levels that I can work with from a risk management process, which is to say, trading through the 2110 level to the upside in the Russell, for example, is going to give traders reasons to raise their stop orders to the next level above, right? It's going to give you an opportunity to work to capture those additional moves to the upside. That's the job of the trader. Always, every step of the way, taking actions that improve their opportunity for profits. That is incumbent on you as the trader. The market's going to do what the market's going to do. You just need to know how you're going to act when these certain events play out. And when I say events, I'm referring to certain price levels are achieved to the upside or broken to the downside. And again, remember, frequently traders rely on closing values much more so than, say, intraday price action here. Closing values will be a little bit more instructive. All right. Let's see. Yeah. Great. Many of you have difficulty holding into earnings. Don't blame you for that. I'm very much in the similar boat. I try to hold a position size with which I'm comfortable through an earnings window. That has a lot to do with my comfort, at least. Some traders will employ alternative strategies, maybe utilizing options. We've got a lot of discussions available to you here on the YouTube channel that do incorporate options if you're looking for ways to do that. So give that some consideration here. All right, what other questions might we have? Okay, I think most of the questions that I feel like I can absolutely address in the moment here, but let's move off of our majors and let's just go through a brief review of sectors, and then we're going to hit up some individual equities for you all. So energy, not really. Okay, we're going to do this as what I like to call chart triage, everybody. This is going to be speedy. And ultimately, what we're looking for are auditory replies. Basically, is my initial look at the chart telling me something? What is my reaction to seeing the chart? Initially, this is a meh. I don't see a whole lot to work with. Are we near support? Sure, we could be. But from a trend standpoint, not a lot to work with here. Moving on down the line, materials, meh. Are we at resistance? Potentially. We've got a level here pretty clear that we've been unable to push through. That kind of stands out. But again, if you're a trader, you're looking for actual trends that are already developed. So this stands out, all right? Moving on. We've got industrials. Industrials, a lot different than what we've seen so far. What do we have? We've got a downtrend that has broken. And since the broken downtrend, we've got an excellent upside trend. Now, new traders probably want to see the 20-day moving average maintained there. All right, so industrials still looks bullish above the 20-day since, wow, how about that? April 23rd, same day as the SPX, same day as the NDX as well. All right, the discretionary looking to bust out, little bit of resistance over the last few weeks right here, right? Trying to get through this level, very important. But where do we have support? Back here at the confluence of the 20 and the 200-day moving average. So a lot of traders would tell you it might be a little difficult to buy right now because we've not yet broken out, right? But because if you buy now, you're really not sure that the trend is going to hold, or the trend is apt to break out yet. We don't have a close through this level. So in order to be wrong, a lot of traders would look at a close under the 20-day moving average. And again, that's about, well, what about 65 points away, right? So patience might be in the offing here. If you like and prefer, some traders be buyers nearer the 20 or 200-day confluence down here, and then their risk is much smaller. But if you wait to buy, you could also have a smaller risk by allowing the group to actually close at new highs, right? And then you can place your stop really tight, like below the level of the breakout, maybe looking at yesterday's low or today's low as maybe a target for that type of exit strategy. Remember, when we talk exit strategy on equities, everybody, commonly we're talking about the basic stop order, which is a trigger price, and then once triggered, it becomes a market order to sell. And that means that our price can't be guaranteed in any way. So just remember that whenever you're utilizing a stop, it's with the intent of mitigating your downside risk, but it cannot guarantee the price at which it would be a seller, because triggers can happen at the open, and we have gap moves to worry about. So there's always risk involved. All right, quickly, let's look at staples. We have an uptrend here, but again, there's not a lot of real action with which to work. The thing that stands out on this chart to me, two things. One, we've got double bottom over the last few months here. So I'm going to call that out. And then we should also point out that with that double bottom, we had a bullish divergence here. See, the last bottom was well below the 30 line in the RSI. But the last bottom here now was above that. So you've got a higher relative low, if you will. And if nothing else, that gives traders some confidence that that ledge can be maintained for support. But you're noticing there's not a lot of action here, everybody, just not a lot to work with. Additionally, I got to point out to the fact that our RSI can't get above 60. So this is telling us that we still have some relative, not tremendous bullish behavior. Doesn't mean it's terrible, but the fact that we continue to be beaten back at the 60 level in the RSI at the same time that we continue to struggle trying to push through this 910 level stands out. So that is basically encouragement to work through a level of price action, forcing the group to do that first before you get a little enthused, if you will. So staples, it's there. It's not looking like the trend we would want to participate in. Healthcare, we've got a real meh here. You've got a downtrend that continues to work. Yes, we had period brief above the 20-day here, but you can see the 20-day continues to provide resistance here, and maybe as quickly as today. Force the market in these groups to make changes. Yes, we have a bullish divergence, but bullish divergences, can appear frequently. They don't necessarily mean a buy signal. So make sure you're following whatever set of rules you give yourself, everybody. All right, financials. A little looking intriguing because we are in that upper range, and yet some of you will say this is a fairly shallow possible head and shoulder play out, right? I mean, the head being fairly wide, and we can't call it a head and shoulder, but because we need to break a neckline in order to do so, everybody. But what are we talking about? I mean, the neckline is ways off here for a lot of traders. Probably would define it as something in this vicinity, because even though we have all of this action, this was all, below the important neckline, and it was really negated very quickly. Still, moves below 785 in the financials would be dramatically different. Notice how we did April 22, there it is, or 23, excuse me, above the 20-day with 1 day below it. So, short-term bulls will tell you the story here remains the same, at least as it has since early April. So financials doesn't look awful by any stretch. And let's not get concerned about the potential for a head and shoulder top until the head and shoulder top plays out as such. Then we can start getting concerned. And remember, that's what we talk about with patterns. Patterns are not patterns. They're just a potential pattern until it plays out that way, everybody. Okay, quickly on tech, and then we're going to move into some of those stocks. Tech looking a lot like the NASDAQ this morning, new high open, faded a bit. Yes, we are, not liking the fact that we've pulled back so quickly here. Let's see how that looks on the 5-minute. All right to the 20-period exponential moving average. We would like to see that R1 line maintained for you. If you're bullish in tech, let's see if that holds. But yeah, getting a little more bleed in this morning's move than many traders were looking for, right? Many were anticipating this being the start of something larger, and it really is not at this moment materializing quite to the extent that traders were hoping. Quick move into communications. So you've got a bit more of a bullish level here achieved of late, everybody, moving through the lows of this little bull flag that we've established. So you've got potential to utilize this level as support. Note the 20-day moving average catching up to that horizontal support line as well. If you'd maintain the 20-day, even a retreat to the 20 would be within reason here. Everything kind of reminding us of what we've seen in the other charts, right? Because many of these groups are going to work in concert, tech and communications and discretionary, all above the 20-day moving averages quickly. So let's see if that holds. We are seeing a little bit of kick in utilities this morning, but the chart's not giving us a whole lot to work with other than a downtrend that's been recently broken. So maybe we've got the opportunity just to work with that very lengthy 200-day moving average. And then notice the real estate is up 1.25, but real estate also in a downtrend still. And some would say, hey, it's below the 200-day moving average. Go ahead and move on. And that's not uncommon, right? So let's, at the request of some of you, let's just peek in here on these majors and see what's going on. Yeah, look at the fade here, everybody. Pretty notable move into support at the true pivot. Right now, this is a significant spot, one where we would like to see this hold up. Obviously, an inability to do so is going to bring some more negativity. The VIX popping, sure, is not an uncommon scenario as it relates to the broader moves we're seeing here. So yeah, this is notable, and I think speaks to some of that uncertainty yet again, because now the question is going to become, hey, can we legitimately see the international court rule hold, right? Is there going to be more discussion? I'm sure there's going to be more discussion on it. One of the things that some traders are anticipating is the back and forth, right? Even the president's advisors are confident that the tariffs are going to be maintained and that the court doesn't have the standing necessary to do this. So that conversation's going to remain on the table, I would think. And I would suggest that headlines are going to have some impact on us, obviously. So again, as traders, just put yourself back where you were maybe 5 or 6 weeks ago. How were you feeling at that moment in time? Headline risk was dramatic. Did you take action? Were you holding more cash? Pay attention to how this is impacting your portfolio. And if you're reaching points of discomfort, well, that's telling you something, okay? And that should be something to pay very close attention to. Okay, let's look at what's going on with NVIDIA here, everybody. As we noted, NVIDIA had a great beat, an excellent move in the aftermarket yesterday. You can see our intraday or after hours low down there around 133, popped all the way to 143 and almost 144. Here we have a continued just drawback to the pivot level, just shy of 140. We'd like to see the bounce there, obviously, right? So no guarantee that any bounce that is implemented here holds. We've been, that 20 period exponential moving average being a little bit less of a helpful factor because we're not really trending in this window of time right now, everybody. So that does stand out for many traders, but what we're looking for is what we would like to call a successful short-term test of support. It wouldn't be a bad zone to pay attention to. Notice the move to the upside, the brief pullback in this bull flag that got resolved bullishly eventually. So the lows of last night all coming into play in this zone in here, basically 139 to 140 or so. This is the level we would like to see maintained if we are bullish, right? So paying very close attention to that over the coming moments here. As you can see, all the lines that I've drawn in on my intra period are here on my daily as well. And you know what happens if we are at risk of taking out that ledge that we've now created intraday? We're at risk for revisiting the breakout spot, which is around 136.5, 137, a couple of points. But depending on how you position yourself and how much, where you put yourself, whether it's with individual shares or with options, you might not be capable of sticking with it for a retreat to the breakout levels. So as always, set those levels, know how you want to act, and stick to them as best you can, everybody. By the way, as it relates to NVIDIA, I'm just looking for the detail I had there. I apologize. I didn't have it directly in front of me. Summit Insights upgraded NVIDIA after the announcement here to a buy. Previously had been at hold after the Q1 results and their forward guidance. They stated the risk of double ordering on its Hopper generation of AI and GPU and the risk of China export controls are now priced into the stock, meaning all of that risk is now known and priced in. The analyst says in their research note, Summit also believes that the data center CapEx spending for the training market will remain robust and it will benefit NVIDIA AI, GP, and data center networking business going forward. So that's the reasoning for Summit's upgrade to a buy from hold after guidance. And of course, if we're looking at levels from an eyeball standpoint, everybody, 144 to the upside, essentially the high we've intradayed here. And then you've got the 153 level above is the all-time high. So, if we can establish that stair step on NVIDIA, potentially the opportunity to revisit 153 is on the table. But as always, Zanson, I'm going to echo your viewpoint. It's never helpful to be greedy, or I should say never. Rarely am I going to say never or always. So it can be risky to maintain greediness. Yes, it can benefit the trader in the short run if you're playing it, momentum based and whatnot. But I just think it's notable rather as it relates to the overall market, because we've had some leadership from Bitcoin. It has been the so-called risk on move. And there's been a little bit of a brief consolidation here as we sit on this ledge. So let's see if that continues higher. Okay, we're at time, everybody. I'm going to have to wrap it up there. Before I do, I'm just going to remind you all to make sure you're subscribed to the Schwab YouTube coaching channel here. You can do a quick search, your favorite search engine, Trader Talks and Schwab Coaching. You'll find this page. Don't forget to hit the subscribe button, and new posts are available. If you click on posts, you'll also be able to find our upcoming schedule right here. And so for many of our classes, they are going to be on a consistent scheduled basis, making it very easy for you all to remember and note when we're going to be on for you. Choose your favorite coach and show up and participate. We love having you guys do that. So thanks to our friend John McNichol in the chat. Thanks to all of you for being here and participating. Please follow me on X at Kevin Horner CS. And make sure you're subscribed to the Schwab YouTube coaching channel as always. So have a great Thursday, everybody. I look forward to seeing you all again real soon.